In this video I'm going to set up a couple of, one trading strategy. I'm going to set out a synthetic put strategy. So this is in a sense, first of all, it's an option trading strategy. And the strategy is designed to replicate a long put. So it's synthetic. So I'll just say synthetic long put. Okay, so the idea is, what if put options didn't trade in a particular market, or didn't trade in a very liquid fashion in a given market? What might a trader do? And in principle, he could long a call position and short a stock, and the combination of those two would produce overall portfolio of equivalent to a long put option. So now to set this out, it requires that we set out the Black-Scholes model, and we'll have a look at that. So let's set up the Black-Scholes model. Now we have code in this developer, in the Visual Basic Editor, and I have called up BSM call. So let's take just that little bit of relevant code and go back into our spreadsheet, and we'll paste here. So we'll just say paste, and then using the order of the variables here, we'll say, okay, there is a stock price, an exercise, a time period, a risk-free rate, Q, and V, lowercase v. And we'll just insert, and we'll just put in nominal values. So perhaps we go with 100, time period 1 year, risk-free rate 5%, time dividend yield 0, volatility 20%. And if the function works correctly, we know from previous calculations this should be about 1045. So 100 K is 100, T is 1 year, risk-free rate 5%, no dividend yield, but we'll still link it to B9, and V, the volatility, is in B10. And when we return, we don't get a value, so perhaps we didn't enter the code properly. Let's check. Okay, so the function didn't seem to work initially. I just closed it down, and I reopened and enabled macros. Okay, so sometimes if there is an issue in terms of functions not working, it may not be coding, it might just be that macros weren't enabled. It's also important when you save files, you save as, and if you have Visual Basic code, make sure you save with as an Excel macro enable workbook. Okay, so we have 1045. Okay, now I want to look at what I want to replicate is a long put position. So a put would normally look like, if you think of a put option for 1 second, we might think of a range of different stock prices, 10, 20, and so on, all the way down to, let's say, 200. And a put option is equal to, a long put is equal to maximum, the value of the exercise, so typically K, minus the value of the underlying asset, or 0. Okay, so if we designate the exercise to be 100, the payoff on a long put option would be equivalent to maximum of the stock price or the exercise price. We'll F4 that to lock the cell reference, minus 10, 0, close brackets, and we just pull down. And to pull that, to demonstrate what we have, insert, and then just a scatter graph, and we'll take this option. And that looks like the intrinsic value of a put. Okay, long put position. But I want to replicate that using a call option, a long call option, and a short position in the stock. So first of all, to get a long position in the stock, we could say, okay, the payoff from a stock price would be equivalent to, so we'd have a range of stock prices, and the payoff on a short stock would be equivalent to, so short stock would be equivalent to, we could write it this way, K minus S. So we take whatever the price it is, we pay for, we agree to sell the stock at, and then where the price of the stock goes. So for instance, it could be 100 minus the stock price, and we pull that down. And if we were to map that, we could observe, if we took these two together, insert, we could see how the short stock position is replicated. So if we agreed to sell the stock at 100, if the stock price was higher, we're losing money. If we have a short stock position and the stock price falls, we make money. So typically with a short position you gain as the stock price falls. But we might be more specific here. We might link this 100 back just to the exercise and just put it here equal to 100, just for convenience, and then pull this down, and we get the same results here. Okay, so that's the short stock, and our contention is a short stock position plus a long call is equivalent to a long put when combined together. So let's make our long call. A long call position is equal to the maximum of the stock price minus the designated exercise, F4, comma, 0, close brackets, and we can pull that down. And if we incorporate this in, if we select the data and add, and take the exercise, the stock prices, and the varying payoffs on the long call position, that's what we would get this. So the long call and the short stock could be represented as so. However, long call positions, generally the payoff normally will incorporate in a premium. So how much might the premium on a long call be? Well, Black-Scholes provides us with an estimate, if so long as we know the parameter inputs, so long as we have parameter inputs, we can estimate the premium on a long call. So for a long call with premium, we might say equal to long call minus premium, and we'll hit F4 and subtract that out, and we can incorporate that in. So to incorporate this in, we would say select data, add, and I would say long call minus premium, and on the X series we have just the underlying asset prices, and on the Y series we have the long call with premium. Okay, and of course we can get rid of the series 2 here because it doesn't incorporate into premium, and then we can ask, okay, long call with premium, what is, if we combine both the long call and the premium, so the short stock, the long call, the premium and the stock position, short stock position. So if we take the sum of these two, take the short stock plus the long call with the premium, and pull down and incorporate it into the diagram. So okay, let's edit this one and remind ourselves that's the short stock position, and hit OK. And then in addition we want to add in the, well, let's not give it a name for a moment, well, we could call it portfolio or combination, and we have the X series and we have the portfolio, and let's have a look at that, hit OK, and we can see now the red, which is the combination for all the world, looks like our usual pot payoff configuration. So what we've demonstrated here is that the long call combined with a short position in the stock provides us with a portfolio that's equivalent to a long put or a synthetic put. So we could just redesignate that as being that combination. Just edit and just say equal to synthetic put. Okay, so the long call and the short stock position provides us with a payoff, even when we take account of the premium, provides us with a payoff equivalent to a long this red one, a long put. And this put then, if it was created using a short stock and long call position, it would be, we might use the term synthetic put. Okay, so I'll save and post.